Hey guys, welcome to a new video. So everything's looking pretty flat right now. I mean, the NASDAQ futures are down about 0.5% at the time of recording this video. So looks like we're in for a bit more volatility and pain this week. Bitcoin's actually is hovering around 69K, but it was around 66, 67K over the weekend. So it's up a touch. Gold seems to be down a tiny bit. But again, we're still in this extreme fear zone, which is a great buying zone in my opinion. I think this is where the great buying opportunities are. So in this video, I'm going to talk to you about some of the ETFs that I think are just great buying opportunities right now. There's quite a few ETFs, and then there's some single stock ETFs. I'm just going to run you through them. But of course, this is very risky stuff. The high yield ETFs are risky by nature. And so this is not financial advice. This channel is purely based on my thoughts as I navigate my own personal investment journey. Please, please, please always do your own research. So we're in extreme fear still. The NASDAQ was up a bit towards the end of the week, but I think anything around here, we're still in a great buying zone. So let's get into some of the ETFs that I think are great opportunities right now. The first one being TDAX. This is the leveraged ETF based on the NASDAQ 100, based on TDAQ, TDAQ, from the guys at Tap Alpha. So it's basically 130% exposure to the NASDAQ 100 through their other ETF, TDAQ, which means you get, if you're buying in extreme fear, which we are now, then historically it's a good time to buy, right? Because I did a fear and yield framework. I did a whole video on this previously, probably a few months ago now. And the framework is all about not buying anything leveraged when we're in neutral or in greed. So just DCAing into TSPY and TDAQ, which is essentially the S&P 500 and the NASDAQ 100. No leverage ETFs during times of neutrality and greed, just DCAing into them. But then in times of extreme fear, actually buying the leverage versions. Why? So this is the light leverage version T6 of the S&P 500, and this is TDAX, the NASDAQ 100 leveraged ETF, 130% exposure. Why? Because when we're in these times of extreme fear, when we come out of them, we can use that leverage to get better total returns, better profitability, better run to the upside. So we're buying in this extreme fear, in these big corrections, big dips, and we let it we DCA in extreme fear, let it run up, and we make a lot more money that way. We DCA in here, like where we are now. This isn't on this chart, but down here in extreme fear, we're buying the leverage ones. And so that's why I really like to buy the leverage ones when we're in extreme fear, especially on something like the NASDAQ 100, which is something we all want exposure to, in my opinion. I think it's great to have exposure to the top 100 stocks within the NASDAQ. And so this is great growth and income because it's leverage. We're going to eventually, when all this kind of settles down, there's not so much uncertainty. Eventually, something's got to give, right? We're not always going to be in extreme fear, so we're going to come out of it. So we buy now, we wait, we DCA in, then we got this this leverage exposure to the NASDAQ 100. And because it's leveraged, it's a higher distribution rate. TDAQ pays about 17%, but TDAX, the leverage version, is about 25%. So it's a much higher distribution. It's a little bit more risky, but in times of extreme fear, I think it's a great ETF to go for. The guys from Tap Alpha, it's doing well. It's actually not doing well because it launched at a bad time, but it's a good time to get into it. All right, the next one is NUKX. This is a nuclear income ETF from the guys at X Funds. I'm very excited about this one. Why? Because energy, we're kind of in this energy bubble where we all need energy. Oil is obviously rising. We haven't got as much access to oil because of what's going on. But these tech companies, AI infrastructure, data centers, they need energy to be able to power this next wave of AI and this tech revolution. And so this is a huge part of that. Nuclear is a massive global theme. It's reliable, it's clean base load of power, and it's growing in demand massively, right? So it's the energy and AI demand narrative. It's basically the power behind the AI infrastructure big going forward. So energy is massive in that part. AI dense data centers and reindustrialization digitalization are driving unprecedented energy needs. We need more and more energy. That's why all the big tech firms, all the big Mag 7 tech companies are doing deals with nuclear companies right now, because they need as much energy as they can for all their initiatives going forward. And then, of course, it's got the income overlay for options. So it's a 36% distribution. It's got great holdings. I'll show you the holdings here, top 10 holdings of NUKX. It's got like some extra cash, but it's also got the uranium ETF. It's got GE Vernova, Next Era Energy, Duke, Dominion Energy, Cameco, Vistra. These are all great companies that have forecasts, and the analysts project to do extremely well over the next 2 or 3 years. So for me, I've been just buying into this. I just entered a position, a couple of weeks ago, as we started to get into its extreme fear, and I'm just DCAing into it slowly. I think it's going to do really well going forward. And I really like the way X funds set up their income ETFs. It's got good upside as well as good distribution rate, 36%. It's not too high. It's not going to have a lot of NAV erosion. Like BLOX, it's going to see a lot of upside as well. So that's what I'm really after, is upside, capital appreciation, as well as that income, that 36% distribution rate. So I think this is going to do really well going forward. So that's kind of my second pick. And of course, sticking with the X funds theme, I've got BLOX in there. Why? Because BLOX is a basket of crypto, Bitcoin, and kind of AI funds, actually, companies. But we're in a Bitcoin bear market. So again, it pays a 36% distribution rate. It's got that high growth and high income. But and it's a Bitcoin bull run catalyst. Now, we're in a Bitcoin bear market. We're in a crypto bear market at the moment. If you don't believe in Bitcoin, don't get into BLOX. But in my opinion, Bitcoin, once we get through this bear market, and who knows how long it's got to play out, this could be a full-on crypto winter that could last another 6, 7, 8, 9 months. We don't know. But if you just keep DCing into it, eventually you will get those highs. If we go to BLOX on here and we go, so look at these highs there. This is just price, obviously. It was up 43% in price alone, and now we're down, and people that were buying here are obviously in pain. I didn't buy BLOX because I was quite heavy into MSTW, MSII, COII, all those other kind of Bitcoin and crypto related ETFs, and now down massively, 50%. But we're in a bear market. Once this continues, and we eventually get out of it, this will run up again. It will run up again. So there's a lot of opportunity, both in terms of upside, capital appreciation, and in distributions. So 36%. So, and when we go up, then your yield on cost is actually going to be more than 36%. If you've got an average cost price down here, we rally up, say you go up 30, 40%, your actual yield on cost is going to be more than that. So I think it's a good time to be DCAing into BLOX. I really like their holdings. It's not super risky. It's mainly Bitcoin and Ethereum. I think Ethereum is going to have a great cycle. It's got Wall Street adoption. It's got tokenization going for it. I think Ethereum is going to do really, really well over the next couple of years. But it's also got some AI stuff. It's got TSM. It's got NVIDIA. It's got data set like AI infrastructure plays like Iron. I actually hold this as a growth stock in my growth portfolio. It's got HAKY, so blockchain Bitcoin mining. I really like its portfolio and how it has really good upside growth potential as well as income. So that would be my third one, Blocky. Now, what's next? HAKY. This is cybersecurity. This is the cybersecurity play. Why cybersecurity? Well, cybersecurity is supposed to be doubling in terms of its growth, its market cap within the next few years. Why? Because of AI and this technological boom. We need cybersecurity on that. Essential cyber defense, high growth cybersecurity stocks, AI driven protection. We need that protection. So all these cybersecurity companies are going to benefit massively from this AI boom. So it's an option strategy, income, and defense megatrend, growth and income. Now, the distribution rate's not massive, but of course you get the growth because it's not huge. There's not going to really be any NAV erosion, so to speak. It's going to have a lot more growth potential, a lot more capital appreciation because of the underlying stocks that it holds, which are, these are the top 10 holdings. So you've got Broadcom in there, Fastly, CrowdStrike, Palo Alto. These this is a bit of a mix up on the AI side of things, but these are great companies. And if you look into cybersecurity as an industry, it looks like it's going to do very well over the next few years. And because of the basket, it's going to have a lot of growth potential. It's not the greatest of, if you're after the super high distributions, this probably isn't the play, but it's a much safer play, in my opinion. So I think that's a great option right now because it is down. HAKY is down. If we go to here, it only launched quite recently, so it's not really kind of a fair thing, but it went up just at the end of January, because January 2026 this year was actually quite a good month, and then that's when everything kicked off. So it's down quite a bit, it's recovered a bit, down again. We've had so much volatility. So here, 23.57, that's the share price at the moment. I think anything under 24 is a great price for HAKY, because I think we'll have good growth and it'll have like decent 16% distribution rate. So a little less risky. I think a safe bet for the next few years, in my opinion. Now, so sorry, I'm losing my place here. HAKY. So that's the holdings of HAKY. And of course, number 5, my goat, my fave, CHPY, my baby. All right, CHPY. I've talked about CHPY loads of times. It's from YIELDMAX. It's got a distribution rate between 35 and 45%, depending on what the market's doing. It's just semiconductors, chips. It's that AI and semiconductor kind of mega trend, and it's just been so good. And it's hardly been beaten down. Like if we look at, let's look at this. This is all 5 of them, and this is over time. Now, 3 of them launched very recently, so it's not really fair. But since CHPY launched, CHPY is the oldest of these 5 ETFs, and it's up 82% total return since it launched at just, a year ago? Yeah, less than a year ago, or pretty much a year ago, actually. 82%, and considering all this volatility that we had, and we're down here, it's held up so well in comparison to other things. So I just love it. It's such a good ETF. And then you can see BLOX here. BLOX was up, beating CHPY at one point. Like if this was a fair comparison, we'd go like this, or like this, let's say. And you see BLOX. The BLOX has got way more of an opportunity to do well from a bear market position, because look, BLOX was up 57% from the same timeline, up 57% total return compared to CHPY. But CHPY's way more stable. CHPY, obviously, BLOX, Bitcoin, crypto, it's cyclical. It's going to go big bull runs, huge volatility, bad runs to the downside, bear market, and you've got to really, really deal with that volatility. You can't be buying at the top. You're going to get absolutely crushed. So you've got to buy an extreme fear, and when we're in a bear market like now. But CHPY, much more stable. You can almost just DCA into CHPY, but definitely in times of extreme fear like we are now, because CHPY is down. If we go to CHPY here, and we go all, is this CHPY? Yeah, all, and then you can see it's still up. There's definitely no NAV erosion with CHPY. We're still up, but this is quite a nice dip. This is quite a nice kind of correction. So anything here under 56, 52, I bought at 52.50. That was a beautiful entry. I was loving that. I was like, how do I get more of this CHPY at 52.50? I don't have much dry powder at the moment, so I'm kind of just using my distributions to reinvest into these, especially CHPY around $52, $53. I think that's a great entry. HAKY, I think it's pretty good. Anything under 53, NUKX. These are all new, so it's not really like, it's not going to look, the chart's going to look awful. But NUKX, my average price is around 42.50. I bought some at 43, and then it went down to 42, and I bought it here. So yeah, anything under 43, I think is great. BLOX is like very volatile, but I think, anything around here is really good at the moment, because we are in just a big. Just take your time with BLOX, because this bear market could last quite a few months. TDAX, it's down a lot. Why? Because it launched it launched at the start of the year, and then obviously we've had all this downside with the NASDAQ 100, all this volatility, and it had that relief rally a bit at the end of last week, was it? And it's gone up quite a bit because it's leveraged, so it will go up more. When we start to have some relief rallies and we start to get out of this zone of extreme fear, or has the opportunity for a lot more upside. And of course, it has that 24% distribution, I think it is. So those are 5 of those kind of more basket orientated ETFs. And I've got some single stock ETFs that I've been dipping into myself. NVII, this is probably my favorite single stock ETF. NVIDIA is down massively. So this here shows the down from the high. So NVII, it's not leveraged as much as the Roundhill version. So you'll see it's not down as much because this is the amount that it's down in terms of share price from this ETF. It's not from the underlying NVIDIA, it's from the ETF. So this is not as much leverage to the downside as the Roundhill ones. Roundhill, it's 120% exposure. So when the underlying goes down 10%, MSFW, so Microsoft goes down 10%, MSFW goes down 12%. So it's going to go down a lot more. But with that being said, we're in extreme fear. Microsoft's been doing really badly, but the core of the business is still really good. Like, it's got so many revenue streams. Like the analyst forecasts from Microsoft for the next few years are amazing. So for me, I've been buying into MSFW. I think it's an amazing buy right now, 50% down from its high. Meta, the same, really good opportunity. These are all great buying opportunities. These are part of the Mag 7. They've all got great fundamentals in terms of what the company's doing, the revenue. Yeah, they're spending a lot on CapEx and all this other stuff, but I mean, it's up to you. You do your own research. That's all I'll say. But I think these are great buying opportunities for all 4 of these: NVIDIA, Microsoft, Meta, and Amazon. And you can choose REXSHARES or ROUNDHILL depending on these. ROUNDHILL is obviously more risky, and REXSHARES for me is probably the best strategy. It's slightly less risky, slightly less volatile, and I think that's probably the best of them. And that's it. I just thought I would share that with you. I think there's some amazing opportunities in the market right now, both from a single stock and, of course, all these kind of basket, more orientated ETFs. NUKX, loving that. I think that's great. Who holds NUKX? Anyone else been getting into NUKX? I think it's going to do really well over the next 2 or 3 years. So I'm using this time in extreme fear, where there's a lot of uncertainty in the market, where prices are down, there's sales essentially, to trying to buy the dip and DCA into some of these ETFs and the single stock funds that I believe in. And yeah, let's see how that goes. Let's see how long this lasts, this time in extreme fear. See what happens in Iran. It doesn't look like it's going to end anytime soon. Trump seems to swing from one thing to the next. Like, you never know what to believe, to be honest. So we'll see how it all plays out. But I'd love to hear your thoughts on it. Do you agree with any of these? Have you been buying any of these? Have you been buying other stuff? I would love to hear your thoughts in the comments. And I will see you in the next one, guys. Cheers.